Kenya School of Management. I'd like to welcome you to the 2015 edition of the annual Spring Henry George Seminar, which precedes the induction ceremony for this year's new members of the university's chapter of Delta Epsilon, the National Student Honor Society in Economics. How many people are either in ODE or will become members tonight? Show of hands, please. So we're well represented here. Before the spring seminar and our annual Henry George lecture, both the spring seminar and our annual Henry George lecture have for the past 30 years been funded by a generous grant from the Robert Schockenbach Foundation. This year, we are honored to have as our speaker Professor Anthony Patrick O'Brien. I'm pretty sure that's an Irish name.
That's what I've been told.
Okay. From Lehigh University, Dr. O'Brien is an award-winning teacher and a distinguished researcher with publications in highly regarded professional journals, including the American Economic Review, the Quarterly Journal of Economics, and the Journal of Money, Credit, and Banking, among many others. His wide-ranging research interests include the evolution of the U.S. automobile industry, the causes of the Great Depression, and the sources of racial differences in income. However, many of you are more familiar with Dr. O'Brien as the co-author of the best-selling Principles of Economics textbook. He and the co-author of the textbook, Glenn Hubbard, have also published highly regarded textbooks for intermediate macroeconomics and money and banking. This evening, or this afternoon, Dr. O'Brien's lecture topic is, why didn't economists predict the financial crisis? Can they predict the next one? It's all yours.
Well, thank you, Ed. Thank you very much for inviting me. Happy to be here. This glorious spring afternoon. In fact, I feel a little guilty having you all inside here too. It's a great afternoon, but I'm going to give the talk anyways. What I'm going to talk about today is economics, economists, and financial crises. I'm going to talk some about the financial crisis of a few years ago and how it was that economists did not see it coming, or most economists didn't, and then talk a little bit about the future and whether the U.S. economy, the U.S. government is well prepared for the possibility of another financial crisis. So, as most people know, economists, by and large, did not expect the disaster that overtook us in 2008, 2009. There's a question, why not? Well, I think it's worthwhile to divide the story in two parts. One is the housing bubble, and the other is the financial crisis that came after the housing bubble popped. For the housing bubble itself, I think most economists actually realized that we were in a bubble. And this graph here is showing you housing prices, which is the blue line, rents, which is the red line. And you can see that for most of the period until about 2000, housing prices and housing rents increased more or less at the same pace. And you kind of expect that, right? Because when you buy a house, what are you buying? You're basically buying the services of living in the house, and you could rent the house if you weren't buying. But then around 2000, you can see that housing prices increased very rapidly till about beginning of 2004. Then they come down pretty rapidly, and in the period since then, housing prices and rents have increased at about the same rate. So while this was happening, I think many economists saw this as a bubble, an unsustainable increase in housing prices. And some people describe it sort of as a buying panic. If you're thinking of buying a house and prices have started to go up, then you think, oh my goodness, if prices are going up 10%, if I'm thinking of buying a $200,000 house, it'll be a $220,000 house next year. I better buy it right away. And some people, though, claim, well, maybe it isn't demand, maybe it isn't this sort of buying panic of people desperate to buy a house before its price goes up. Maybe it's a problem with supply. Right? Maybe it's a problem that not enough houses are being built. So maybe we're sort of chronically going to see housing prices continue to increase at rapid rates. Maybe because of zoning problems. This was an argument that was being made that in order to build a house, if you're a developer, you have to get permission from the local government. And one argument was, people were putting pressure on the local governments not to allow a lot of new houses to be built, either because they wanted more green space or they didn't want more neighbors or whatever. And in fact, this man here, Robert Toll, is the CEO of a big construction company, Toll Brothers, and he famously made this argument. So, at the height of the housing boom in 2005, he had a cover story in Fortune magazine, and he said, really, people who say this is a bubble, they're wrong. In fact, it really is the supply thing, and he said, it's all about zoning. And he said, no, my company, Toll Brothers, is particularly good at convincing local governments to give us the permits, but most companies are not so good at that, and that's the problem. You just can't get enough houses built. Well, where I live in Bethlehem Township, Pennsylvania, there's a lot of kind of marginal farmland. Right? There's somebody has a few cows or a few acres of corn or whatever. They're not usually profitable farms, and most of those farmers are not too reluctant to sell out if you wanted to buy their property to build a housing development. And the local governments are certainly not averse to allowing new developments to be built. And in fact, close to where my wife and I work, there where we live, Robert Toll, in fact, plumped down in the middle of some of this marginal farmland a big housing development in 2004, 2005 at the height of the housing boom. And as I drove by, they had the construction trailer there, and there was this big crowd of people, trying to be the first to get in there when they open their doors so they can pick out exactly the right lot. And I would stop by every now and then and ask the people working there how they were doing. And they said that after every 5 houses they would sell, they would raise the price, $10,000. Right? So the prices were continuing to escalate. And I looked around and I thought, gee, what's the stop? As economists, we always think, when somebody is on a good idea and they start making a lot of profits, other people will cut. So what's to stop other people from competing with Robert Toll by buying some more of this marginal farmland and building more developments? And in fact, that's exactly what they did. Right? The more developments opened up, and housing prices in the Lehigh Valley began to come down as a result of that supply response that we learn about in principles of economics. And in fact, probably the people who were desperately trying to get into that Toll Brothers development, they pay prices that will never be that high again. Right? Certainly in real terms, I don't think those houses will ever be that high again. And I think most economists actually understood that Robert Toll was wrong. In fact, this was a bubble, and prices would eventually come down. So it's hard to criticize economists for not understanding that part. However, it's the next part where I think you can legitimately say economists were, in fact, missing the boat. And that is, after housing prices started to come down, right, that blue line begins to come back down to the red line on the graph, at that point, economists didn't think that much important was going on. Right? So here is Ben Bernanke. Right? So Ben Bernanke, at this point, chairman of the Federal Reserve Board. He has to go before Congress periodically. So here he is talking to Congress May 2007. So housing prices start to fall beginning of 2006. So this is a year of falling housing prices, and also people who had taken out subprime mortgages, people whose credit was a little bit shaky, they got a mortgage anyway, they had begun defaulting on their loans. Okay, so did it matter? Bernanke here is saying it doesn't matter. Right? Saying, given the fundamental factors in place, to support the demand for housing, and so on and so forth. You can read that. And basically what he's saying is, even though housing prices are coming down and people are starting to default on their mortgages, it's not going to affect the real economy, real GDP, employment, and so on. It's not even going to affect the financial sector. It may not even going to be affecting the mortgage market, maybe not even the subprime mortgage market.
Does not see it coming. There's a bunch of other people, if you go back and you read the Wall Street Journal or Business Week or Fortune, essentially everybody, economists, most economists in 2007, most business people, they did not see the financial crisis and the downturn coming. Here's to come, and one final thing. So every year there's an economic report of the president. The economists who are on the staff of the president, they release this report. Supposedly, it's written by the president. He signs it, but debatable whether he even reads it. But at any rate, this is what they said in February 2008. Now, the National Bureau of Economic Research, which dates recessions, after the fact, they tell us the recession had begun in December 2007. Right? It ends in June 2009. So there were a few months already into the recession. So what do they say? They say economic growth is expected to continue in 2008. Most market forecasts suggest a slower pace in the first half of 2008, followed by strengthened growth in the second half of the year. That's completely wrong. Right? What actually happened was we had a downturn in the first half of 2008 and then a catastrophe in the second half, right? The worst downturn since the 1930s. So they were completely off base. So, not to criticize, but almost everybody was completely off base. But why was that? Why didn't people understand what was going to happen? Well, we can think about the economics of it. And if you think about, why is it we'd expect that things that are going wrong in the financial sector, right? People are starting to default on their mortgages, and there are financial securities, so-called mortgage-backed securities, collateralized debt obligations, right? These sophisticated securities, and they were based essentially on people at the end of the month writing out a mortgage check and sending it in, and then, eventually that money got sent to the people who bought these securities. Why would problems there cause problems in the real economy, meaning, for production and employment and stuff like that? Well, economists are great at making lists. You can make a list of like 47 ways in which problems that happen in the financial sector could affect the economy. I'm going to talk about, briefly here, 3 ways, and I'm not really in a story. Famous economist name to each of these 3 ways. Or each of these 3 channels, right? So these are channels by which problems in the financial sector affect the rest of the economy. Well, one could be what I'll call the Keynes channel, right? So John Maynard Keynes, famously argued that total spending is what drives production and output, right? Total spending goes up and down, and it takes the rest of the economy with it, right? Production goes up and down, employment goes up and down. And the biggest part of spending is consumption spending. And according to Keynes, consumption spending depends most importantly on people's current income, but it also depends on their wealth. So one way in which you could have a problem in the financial sector that affects the wider economy is people's wealth declines. Right? So the value of their houses are going down. Maybe they cut back their spending, and that causes problems in the economy. So that's one possibility. Another possibility we'll identify with Irving Fisher, a famous economist of the early 20th century. And Irving Fisher said one of the problems you get into when you have difficulties in the financial sector is that borrowers always know more than lenders about their financial position, right? I mean, you go into a bank and you take out a loan to buy a car, you know more than the bank does about what your income really is and how likely you are really to repay that loan. And so today we call that asymmetric information, right? You have more information than the bank does. So So what does that mean? It means that lenders require borrowers to put up collateral. And they also want to lend to people who have a lot of net worth, right? So that if you default on the loan, they've got something they can grab. And so Fisher said one of the problems in a financial crisis, or problems in the financial system, is the collateral, the value of the collateral of borrowers starts to decline. And their net worth starts to decline. So then the lenders look at the borrowers and say, well, your collateral is not as good, your net worth is smaller. We are either going to raise the interest rates we charge you, which of course causes the borrowers to borrow less, or maybe we'll just completely cut you off, right? The economists call that credit rationing. Whatever interest rate you want to pay, we won't lend to you because we're suspicious of your ability to pay us back. So that's another way in which problems in the financial sector could cause a recession. Now, the third way we'll identify with Ben Bernanke, right? So even though Bernanke didn't realize this was going on, Bernanke had talked about it in a different context early in his academic career. And early in his academic career, Bernanke wrote about the Great Depression. And there's a story about the Great Depression that says the key reason why in the 1930s we had this Great Depression was bank failures. Milton Friedman and Anna Schwartz, right, two famous economists back in the 1960s, they wrote this book and they talked about the fact that during the 1930s, you had a wave of bank panics, right? 5,000 banks in the United States failed. And they said, that destroys a bunch of deposits because the banks go out of business. And also it causes depositors to become nervous. They don't want to put their money in the banks. They take their money out. So, in the technical money and banking phrase, we'd say the currency to deposit ratio goes up. The money multiplier shrinks. And the bottom line is that the money supply declines, M1 and M2. Right? So you get the biggest declines in M1 and M2 in the history of the country. And so this was a famous story about then why you have such a bad depression. If you think M1 and M2 are really important, then this is the explanation. Bernanke said, actually, Friedman and Schwartz kind of missed the main problem with bank failures. And that was disruption intermediation. Right? Banks are intermediaries. They take in deposits from people, and they make loans. And a lot of the people who get those loans don't have any other way to get credit. Right? So Bernanke said the problem wasn't so much M1 and M2 falling as the banks going out of business or the banks reducing their lending. So if you're a small business person and the only way you can finance your inventories or finance anything else is by going to your local bank and taking out a loan, and the local bank fails, or the local bank's deposits have shrunk so they don't have the money to lend to you, that's a big problem. So Bernanke said the problem in the Great Depression and potentially the problem in other financial crises is as these financial institutions like banks that are engaging in intermediation, as they fail, then those people who can only borrow from banks, particularly businesses in the modern economy, in the 1930s it would be mainly businesses, in the modern economy it would also include consumers who are borrowing money to buy houses and cars and stuff like that. Okay, so the point of this then is economists could have had in the back of their heads these three ways in which, hey, housing prices are coming down, the value of securities based on mortgages are falling. Should we expect a disaster? We got a disaster. Should we have expected it? They could have thought of it in these ways. And so were they dumb not to have realized that those three ways would come into account? Well, first, think about the Keynes way and say, well, should we have all said, gee, there's this big decline in housing prices, people are going to stop spending, the economy is going to fall off a cliff. Well, we'd actually had, a few years before that, another big decline in wealth. And that was the dot-com bubble. Right? So in the late 1990s into early 2000, there had been this big increase in stock prices of internet firms. Pets.com and eToys and Webvan. People got really optimistic that nobody will buy dog food except online through Pets.com, and nobody will buy toys except through e-toys. Everybody's going to get their groceries delivered by web van. And these companies had almost no revenue, and they had tremendous losses, but they had really high stock prices because people were really optimistic about them until the beginning of 2000. And then that bubble popped. People decided, Webvan and eToys and Pets.com, not only do they not have any profits now, they're never going to have any profits. Stock prices declined drastically. $6 trillion worth of stock market wealth wiped out from the first quarter of 2000 to the third quarter of 2001. So did that cause a huge recession? No, it didn't. Right? We lost $6 trillion worth of wealth on the stock market. There was a recession in 2001, but it was a pretty mild recession. So economists looking at this would say, well, what happened with housing? And the fact is, with housing, we lost only about $2 trillion worth, $2 trillion worth of wealth from the beginning of 2006 till the fourth quarter of 2007 when the recession began. And then we lost another $2 trillion over the next year. And it really wasn't until 2011, after 2 years after the recession was actually over, that we got to the level of wealth loss that we had lost on the stock market. So you would say that through this channel, we wouldn't have expected the popping of the housing bubble to have led to a severe recession. Now, you can get really subtle and say, oh, well, people respond more to the decline of value of their houses than they do to the decline of value of their stock, because it's all in their retirement accounts and they don't even read their statements. But still, declines in wealth typically don't have such a huge effect on the economy that economists were dumb not to have said this declining housing prices is going to cause a big problem. Okay, well, what about the Fisher part of the story? Remember, the Fisher part of the story is, okay, you begin to have financial stress, and people whose credit starts to deteriorate, and then they either can't get loans or they have to pay through the nose in very high interest rates. Well, one problem we have there in evaluating that is, well, how do we measure financial stress? Well, the economists at the Federal Reserve Bank of St. Louis have done that. They've taken about 15 or 18 different series, data series, and they've mushed them together into an index. Like any of these things, you can sort of debate, this thing shouldn't be in there and that thing should be in there, and how do they weight these things and whatever. But they've done it, and for this index, 0 is sort of normal levels of financial calm or stress, and negative values are not stressful or relaxed. Now we get negative values, so things are calm on financial markets, and then positive numbers are stress. So in this thing, or some of the stuff like Irving Fisher would have said were important, looking at the difference, the so-called credit spreads between interest rates on riskier loans and interest rates on risk-free loans, and stuff like that is measuring stress. So this doesn't even become positive until the middle of 2007. And what's that big spike there? That big spike is the failure of Lehman Brothers in September 2008. It's only then that it really goes up. So what is that telling us? Remember, this is not surveying economists telling them, do you think that we're having financial problems here? This is actual, market participants, buyers and sellers, of securities, people whose livelihood depends on trying to figure out what's going on in financial markets. They didn't think anything important was going on until at least the beginning of the middle of 2007, and didn't really think that there were any problems until essentially, the piano had fallen on their heads. So, it's like Wile E. Coyote in the old cartoons. They were off the cliff, and in midair, and then Lehman Brothers happens, and they plummet to the earth. So it's hard to say that economists somehow missed the obvious sort of Fisher effects. Collateral is deteriorating, net worth is falling, risky interest rates or interest rates on risky loans and securities are going to rise, and that's going to cause big problems for the economy. Because really that didn't happen until the thing had already practically unraveled. So what really was going on then in terms of how we can look at these things, and it really is the Bernanke the Bernanke channel, right? That problems with intermediation channel that really turned out to be what went wrong. And that was the part that people didn't really understand. People meaning economists and really everybody else. And really what was going on there was a problem with so-called shadow banks, right? So we're used to commercial banks, you deposit, they take in deposits, they make loans. But there are a lot of other financial firms, right, that we've ended up calling shadow banks. And what are they? Well, there are things like investment banks and broker dealers and money market mutual funds and exchange traded funds and insurance companies, things like that. They had been continually growing without people paying a lot of attention. There's an economist, Paul McCulley, who was at that point the chief economist at PIMCO, Pacific Investment Management Company, largest bond dealer in the world. And every summer, the Federal Reserve Bank of Kansas City has a conference in Jackson Hole, Wyoming, and financial people and economists, everything, they go there and they look at the Grand Tetons and they think deep thoughts. And Paul McCulley got up there in the summer of 2007, and he said, you know what? None of us have really been paying all that much attention to it, but these other non-commercial bank parts of the financial system, they've gotten really big. And he, at least I think he was the one who coined the phrase shadow banks. Like a year later, Tim Geithner, who at that point was the president of the Federal Reserve Bank of New York. This was 2008, before the election. After the election, President Obama appoints him Treasury Secretary. But at this point, he was president of the Federal Reserve Bank of New York. And in mid-2008, he gave a talk to the Economics Club of New York. And he said, I was at Jackson Hole, Wyoming, and I listened to Paul McCulley. And when he said that, I had my staff gather data. And you know what? Not only are shadow banks important, they're actually 50% larger than commercial banks. Okay, but so what? So why do we care that these non-commercial banks got bigger than the commercial banks? Well, there are a number of reasons why it turned out to matter. One was that the regulatory structure of the financial system was focused on commercial banks, not on shadow banks. Right? So, the Federal Reserve was set up in the early 20th century to be a lender of last resort to commercial banks. Commercial bank has a problem, they need some emergency loans. The Federal Reserve was there to make those loans. The Federal Reserve was not there to make loans to investment banks, to broker dealers, to money market mutual funds. If they got in trouble and needed emergency loans, the Federal Reserve was not there to give it to. The FDIC, right, insures deposits in commercial banks. It was set up by Congress during that period in the early 1930s when all these banks failed and all these people said, my God, I've lost my savings, I had it in the bank, and it's gone. And Congress said, okay, we'll reassure you by insuring your deposits. The FDIC does not insure the deposits of the short-term creditors of the shadow banks, right? So, we don't usually think of ourselves as creditors of banks when we lend them, when we put our deposits in the bank. But if you put $1,000 in a checking account, right, you're a creditor of the bank, right? You can, you've essentially lent that bank your money. You can pull it out the next day should you feel like it, or an hour after you deposit it should you feel like it. The bank then takes that money you've deposited and they loan it out. If you pull that money back out, then the bank's already lent it out. That's a problem. But you probably won't pull it out. Why not? Because Congress has said it's insured. Your bank goes out of business, don't worry. The way the FDIC actually does this is your bank runs into problems, they usually wait till Friday afternoon, they swoop in, they take over your bank, all the ATMs continue to work, you have no worries. Nothing like that exists for shadow banks. Right? The short-term credit that shadow banks get is not insured by anybody, which means that if people get nervous and they want to pull the money out, there's no reason not to do so. Okay, so this is connected with that. Shadow banks often relied on short-term financing, such as commercial paper and repurchase agreements. So with a repurchase agreement, you're Lehman Brothers, and you say, gee, it's a really bright idea. I'm going to buy all these mortgage-backed securities. Where am I going to get the money? Well, one place they got the money is what are called repurchase agreements. Essentially, they borrowed very short-term, oftentimes just overnight, oftentimes from other financial firms, right? Which is a great idea, provided that the people who are lending them the money kept rolling it over. So, Tuesday turns into Wednesday, and the money is still there. What happens if the money disappears? Lehman Brothers is in trouble. It doesn't actually, it's been financing these purchases, and it no longer has the money. So, Jamie Dimon, who is the CEO of J.P. Morgan Chase, he famously said during the financial crisis, there is one financial commandment that cannot be violated. Do not borrow short to invest long, particularly against illiquid long-term assets. A lot of companies were doing that. It's sort of easy to say don't do that, but that's what intermediation is about. Right? Banks do it, right? Banks take in checking account deposits. Nothing could be more short-term than checking account deposit because you get your money right back if you want it. And they lend it out for car loans and third-year mortgages and whatever. But banks, once again, commercial banks, unlike these other financial firms, their deposits are insured by the federal government. These other companies were not. Shadow banks are more heavily leveraged than commercial banks, right? So one of the other aspects of regulation is commercial banks have to keep a certain amount of capital against their assets. The shadow banks do not, right, for the most part. It's a little complicated, but for the most part, they did not. And that meant that they were more highly leveraged. They had more debt relative to the capital that they have. And there's an incentive, right? If you're a manager of a financial firm, there's an incentive to be highly leveraged, right? Because a certain return on assets, you're generating some money off your assets, you've got these investments in securities or whatever, you're earning something on those. The less capital you have, the bigger the return is. If you have $1,000 worth of capital and you're earning $100 on your asset, that's a 10% return on your equity. If you're a financial manager, that may be what you're compensated on, either directly or if that high return on your equity causes your stock price to go up and you've got options on your stock, then you get your compensation that way. But if you have, instead of $1,000, you have only $100 of capital, just had a 100% return, not a 10% return. Problem, though, is that if the value of your assets start to shrink, if you're Lehman Brothers and a lot of your assets are collateralized debt obligations that depend on people writing monthly mortgage checks who have stopped writing monthly mortgage checks, you got a problem. If the value of your assets shrinks, you don't have much capital there to absorb the loss. The more capital you have, the more you can take a loss on your assets and still remain a solvent firm. Okay, and then connected to that, so the shadow banks themselves are heavily involved in exotic securities, particularly mortgage-related securities, right? Mortgage-backed securities where banks would bundle up mortgages, sell them off to anybody who felt like buying them, collateralized debt obligations, and so on. Once again, there were more restrictions on what commercial banks could hold in their portfolios than what the shadow banks could. And maybe just a second, why were these regulatory differences? Partly it's this history, right, that commercial banks used to be the most important thing, so that's what we regulated. Partly it was also that not only were Congress thinking in terms of let's stabilize the financial system by making sure commercial banks don't fail and that people don't lose their money in deposits, but also they were getting a lot of criticism from the average person who lost money in their bank because their bank went out of business and their deposits disappeared and they either never got them back or In the 1930s, when some of those banks failed, it took you like 10 or 15 years before you got the money back out of your account. So Congress was responding to, the average person losing money. Whereas in the shadow banking thing, it was, the thought was, well, these are big boys and girls. They're sophisticated investors. They're financial firms dealing with each other. We don't need to protect them. They can protect themselves. That was what they thought. It turned out not to work all that well. So, problems with these exotic securities, right? So what were economists missing? They were missing the growth of the shadow banking system. They were missing the importance of these exotic securities to many of these financial banks. Important meaning if they began to lose value, these firms were in trouble. These firms lacked lenders of last resort. They lacked Congress having insured their short-term creditors. What was also missing is many of these financial firms themselves did a very poor job of risk management. Now, economists would say that the risk in these securities was not well priced, right? That these securities these bonds, the mortgage-backed securities, collateralized debt obligations, whatever, they should have had, lower prices and higher yields because they were riskier than people realized. And a lot of the financial firms should have realized it. In hindsight, they did realize it. Maybe at the time they should have realized it, but they didn't have good risk management practices. They weren't investigating themselves independently what was in these securities, and they weren't also looking at their own fragility, meaning they weren't doing the kind of stress tests that get done today in commercial banks, where you look at what's going to happen if the prices of these securities drop by this amount. How will that affect us? And partly they had pushed this out to third parties, the credit rating agencies. Moody's, Standard & Poor's, Fitch, right? If you were Goldman Sachs or Lehman Brothers or whoever, Bear Stearns, you could say, well, maybe we're not doing such a good job evaluating these securities, but you know what? We've hired Moody's, and they've done it for us. Well, that overlooked the fact that there were important conflicts of interest in the credit rating business. Right? The credit rating business began, John Moody himself, and the other pioneers, they began in the early 20th century gathering information on the creditworthiness, initially of railroad bonds, and selling that information to investors. But for various reasons, that business model broke down, and instead, they shifted over to selling the ratings to the people issuing the securities. Right? So the people issuing the securities were paying the rating agencies, and the problem you run into there, if you're Lehman Brothers and you want to underwrite some exotic mortgage-based security, and Moody's comes back and says, well, seems like there's a lot of risk in this. We're not going to give you a good rating. Well, then the next time that you need security rated, you don't hire Moody's. You hire Standard & Poor's. You hire Fitch. So the credit rating agencies had an incentive to be as lenient as they could be in rating these securities. And this gentleman here is Lloyd Blankfein. He was, during the financial crisis, the CEO of Goldman Sachs, the big investment banking firm. He's still the CEO of Goldman Sachs, so he's obviously a smart guy. He's navigated the financial crisis and remained there. And after the financial crisis, Congress, as it tends to do, investigated what went wrong. And they hauled in all the heads of the financial firms, and they raked them over the coals. And there's hours of testimony you could watch on C-SPAN. I watched a lot of this. I probably made up about half the audience, I think, for most of the time. And I was struck at one point by an exchange between Lloyd Blankfein and one of the senators. And one of the senators said to him, well, you guys were selling this stuff and it had a AAA rating. And didn't you feel like you should investigate a little bit closer to, why rely on Moody's to tell you it's AAA? Why didn't you guys investigate it? And he said, I didn't think the rating mattered. senator didn't think the rating mattered. I mean, he didn't know that if you were selling to certain institutional investors, like pension funds, certain mutual funds, and other institutional investors, that they could not even, insurance companies, they couldn't buy these securities unless it had a AAA rating. And Lloyd Blankfein said, I didn't know that. I'm not a bond salesman. Meaning, I wasn't in the part of the company that actually called up the insurance companies and the pension funds and tried to sell them these things. An interesting story, because it indicated that even Lloyd Blankfein, sophisticated financier, head of Goldman Sachs, even he did not realize some of the key facts here, right? So I think that if you're going to indict economists and Lloyd Blankfein and others, why did they not anticipate the financial crisis? The answer is that the financial system had evolved in ways that made it more fragile, namely the growth of the shadow banking system, the spread of exotic securities, particularly ones based on mortgages. All of that had happened. Economists did not fully understand the implications of that. And so when housing prices started to fall, you got situations like Ben Bernanke saying things that probably 90% of the economists would have agreed, namely, I don't think this is a big problem that housing prices have fallen. Turns out it was a huge problem, but economists missed it for those reasons. Okay, so that's the past. Let me do the future real quick. What about going forward? First, think about the financial system. And first off, economists, like most academics, deal almost exclusively with abstractions. I mean, one of the good things about teaching is you go through graduate school and you do nothing but deal with abstractions. And then you get before students, and students, like most normal people, don't like abstractions. They, want concrete. What does this mean? And it makes you stop and think, do I actually know what this means? Or I know what the abstraction is, do I know what it means? And I think the financial system is an abstract. Well, you read the Wall Street Journal every day, there's like 100 references to financial. What are we talking about? Is it like that? Is it like the central nervous system? Is there like a brain somewhere and, hearts and lungs or whatever? Is it like, a river system? Is it the Ohio and the Missouri flowing together and forming the Mississippi? But if you put aside the abstraction, you think, what is the financial system? It's basically two things. It's regulators, the Federal Reserve, Janet Yellen and her colleagues sitting in Washington, D.C., thinking different things. It's, the Federal Deposit Insurance Corporation, the control of the currency, whatever. It's partly that, but what it mainly is are financial firms. It's commercial banks, it's investment banks, it's broker-dealers, it's insurance companies, it's mutual funds, it's exchange-traded funds. And what are those things? Those are private profit-making companies. What do private profit-making companies do? They produce services, and they try to figure out how to produce those services better than their competitors. And what does that involve? Usually involves innovation. Right? It's usually not the path to success to produce exactly what the other firm is producing. The path to success is to produce something better than the other firm is producing. And so we look at financial services, there have been tremendous innovations over the years. I mean, I'm old enough to remember that you used to, if you wanted to get your money out of the bank, you had to trot down to the local branch and you had to present yourself in person. And I shouldn't have looked over at Professor Scale when I said old, but that's okay. And you had to, between 10 and 3 and get your money out. And if you were there at noon, there was a mob scene because everybody was there on their lunch hour. Now, if it's 2 a.m. on a Sunday morning and you need some money, it's an ATM. You pull up, you get your money out of your ATM and you do with it whatever you want to do at 2 a.m. on Sunday morning. And that's progress, I think. I don't know. He's asleep. So we see a lot of things. And when I first started teaching money in banking at Lehigh, there were still states that we had to talk about, unit bank states. What that meant was that, like, if you were in Illinois, not only did you not have interstate banking, so you couldn't have branches more than one state. In Illinois, you couldn't even have more than one branch in the state, which means if you needed a loan in downstate Illinois, your local branch, you basically were getting your loan from that local branch, and they were probably dependent almost exclusively on deposits in that particular area. Nowadays, if you want to get a loan in the Lehigh Valley, you can go to Wells Fargo, right, which is not located in Pennsylvania. Its headquarters is in San Francisco. And they are not dependent on deposit. If I want to get a mortgage in the Lehigh Valley, I'm not dependent on people in the Lehigh Valley having put their money in the bank. What happens is Wells Fargo can grant my mortgage, bundle it up with a bunch of other mortgages, sell that as a mortgage-based security, and somebody in South Korea can buy it. And that person in South Korea has effectively funded my mortgage. So essentially what that's saying is economists would say financial innovation, which is what private profit-making firms are going to do. They're going to try and innovate. For the most part, it increases efficiency. Now, I'm glossing over things. You could say, are you sure that over-the-counter swap trading has really improved my life as a consumer? Probably not, but we'll leave that aside. But it also increases, or has the potential to increase the risk of financial instability, right? Because if you are a manager of one of these firms and you're trying to outcompete other firms, do you care that your innovation might make the system more fragile? No. I mean, how did the shadow banking system get bigger than the commercial banking system? Well, because the shadow banks were offering services better than the commercial banks. Their market share grew as market shares grow for firms that are being successful innovators. Turned out that the instability of the system was increased, but that wasn't really the responsibility of any of the people running those firms. It's difficult to contain, right? If we're going to rely, as I think we have to, and we want to, on private firms to provide financial services, they're going to innovate. Well, is it possible to regulate? You can say, okay, we can't stop financial innovation if we wanted to. Can't we just regulate it and make sure that even if the manager of that particular firm that has this innovation, even if he or she doesn't care whether it destabilizes the system, maybe we the regulators can care? Well, I recently read this book written by a man named John Brooks. It was a series of articles that, he was a business writer. He wrote these for the New Yorker magazine back in the 1960s. And this book, like a lot of other business books, was, Bill Gates reads a ton of books and he promotes them heavily. You go into Barnes & Noble and you pull the business books off the shelf, about every third book will have written on it a blurb saying, this is the best book I ever read, Bill Gates. And as he reads these books, he convinces publishers to bring them back into print, and this is one of the books he did. And in this book is a chapter that this guy John Brooks wrote about the great stock market crash of 1962. Now you might say, I didn't know there was a stock market crash in 1962. Actually, there wasn't. What happened in 1962, there was one day in 1962 when the stock market fell, the Dow Jones Industrial Average fell by 35 points. Now, if you follow the market, 35 points, it's nothing, right? But that's nothing when the Dow was at 18,000. In 1962, the Dow was at 650. And that 38 points, 32 points, whatever it was, that was the largest decline in stock prices since the great stock market crash of October 1929. Right? So this is like 30 years after. 30 years had gone by. Stock market had never fallen 35 points in one day. So according to Brooks, at the end of trading on that day, people were really worried. Regulators in Washington were worried. People on Wall Street were worried. What were they worried about? They were worried about a financial innovation that they thought might result in a true crash when the market opened the next day. What was that innovation? was stock mutual funds. Today, stock mutual funds, they're the most vanilla, nothing innovation we can think of. But in 1962, they were big, they were fairly new. And what had happened was that most individual investors had fled the market after the great crash of 1929. But by the late 50s, early 60s, they had begun to trickle back and then begun to come back in fairly large numbers because stock mutual funds, right, gave them a low-risk, diversified way to get their toe back into the stock market. You buy a stock mutual fund, it only takes a little bit of money, and your investment is spread out, you get diversification, whatever. So why was everybody worried about that day in 1962? They were worried that now that a bunch of individual investors had flooded back into the stock market because of stock mutual funds, they were all going to panic and sell. That instead of the market being dominated by savvy, long-term investors, all these mom and pop investors who had bought into stock mutual funds, they were going to wake up that morning, read in the newspaper, biggest one-day decline in stock prices since 1929, or they heard Walter Cronkite say it on the news the night before, and they were going to sell. So, according to Brooks, people were saying, oh my God, why did we ever allow stock mutual funds to come into existence? This is going to be the end of the world. Turned out, the next day, the market didn't fall. The market bounced back. And in fact, the managers of the stock market mutual funds were big buyers. They weren't sellers. Some individual investors panicked and sold out. Most didn't. And the stock market mutual funds actually stabilized by being big buyers. So what does that anecdote tell us? It tells us that if you're a regulator and you're trying to figure out whether any particular financial innovation is going to cause more or less instability, you don't really know. Very smart people in 1962 all of a sudden thought, oh my God, we allowed stock mutual funds to exist, and now we're going to get killed, and it didn't matter. So that means if you take the first part of what I talked about and said, gee, economists did not understand that the growth of the shadow banking system and the growth of exotic securities was setting the financial system up for a crash. The truth is, it's really hard to know as the financial system evolves, which it does. It's really hard to know whether or not particular innovations are going to make things better or worse, which means regulation is really hard. Regulation is really hard because it's hard to pick out the good innovations from the bad. So what do? Well, here's another book, an old book published in 1872 by a man who told us what to do. And I think he had a lot of good things to say. Walter Bagehot, his name was. He wrote this book called Lombard Street, back in 1872. There he is, fine Victorian-looking gentleman, nice Victorian beard. And what Bagehot said was, if you're worried about problems in the financial system, he said, sometimes financial firms fail because they make bad investments, right? You're a bank, and there's a swampland out there, and some developer says, oh, that swampland, perfect for a big housing development. Lend me, $10 million, and I'll do it. And doesn't work out. He loses the $10 million. Your bank is insolvent, and you close. So that's certainly a problem. But Bagehot said, correctly most economists would say today, really it's more liquidity problems, meaning not that the bank has failed, but in a financial panic, or even the beginning of a financial panic, the problem you're going to get into is that depositors may want their money back, and the bank doesn't have the money. Right? There's just a liquidity problem. The loans the bank made with that money might be perfectly sound, but the money just isn't there. The instability in the banking system, a couple of seen two of my favorite films. There's this film, you may remember, the scene you may remember from the film Mary Poppins, right, where George Banks, the father, he's a banker, and he takes little Michael Banks to the bank, and little Michael Banks has tuppence in his little fist, and he wants to spend the tuppence because he wants to buy breadcrumbs to feed the birds, and the father is trying to pry the little kid's fingers open. He says, no, don't you understand compound interest? You put that 2 cents in the bank, and 50 years from now, you're in great shape. And these gentlemen in top hats, as they're watching this struggle, they say, my God, the bank is not letting people have their money back. And so this enormous crowd comes to the teller's cages and wants their money back. It's exaggerated, but it does highlight the fundamental problem with banking. And that is that if, in the era before deposit insurance, if you want your money back, you better be first in line, right? Because the bank doesn't have much of the money. Most of it has been lent out. There's a liquidity problem there. And unless, we'll talk about the unless part, but if you're not first in line or very close to it, you're going to be in trouble. Another scene from a great movie where Jimmy Stewart here is explaining, why he can't give people their money back. I forget the details of exactly the thing, but basically, Mrs. Smith is there and says, give me my money back, and Jimmy Stewart is saying, I haven't got the money, Mrs. Smith. I took your money and all the other money, and I lent it out to the Jones family, and they built a house with it, and the money's only going to come back as they gradually pay off that house, right? He's borrowed short-term from Mrs. Smith, and he's lent long-term to Mr. Jones. Jamie Dimon tells us don't do that, but that's what intermediation is about. That's an essential service. So Bagehot said, what do you do with that? What do you do in that situation? He said, it's easy. You have a central bank, and they lend, and they lend, and they lend. They must lend to merchants, to minor bankers, to this man and that man. Whenever the security is good, in wild periods of alarm, one failure makes many. In other words, one commercial bank might fail, and that causes a panic as people say, oh my God, there's problems with banks. I better get my money out. And the best way to prevent the derivative failures, the other banks failing, is to arrest the primary failure. Keep that first bank from failing. So 2 lessons here. One is Bagehot is saying, lend to everybody, right? That people are having liquidity problems, lend to them. And the second thing he's saying is focus on the source of contagion, even if it is a single firm. This is basically someone from the Bank of England saying, that's exactly what we do. We'll skip over that in the interest of time. Here's some important stuff from Bagehot. If it is known that the Bank of England is freely advancing on what in ordinary times is reckoned a good security, commonly pledged, what is all this saying? He's saying you should make loans as a central bank to anybody who has a security security meaning bond, a loan, whatever, that in normal times, not right now, but in normal times, would have enough value that they could repay the loan. The only safe plan for the bank is the brave plan to lend in a panic on every kind of current security of every sort on which money is usually lent. So, just maybe to go through this pretty quickly here. So, what he's saying is that one of the problems with a lender of last resort is what economists call moral hazard. That if one objection to Bagehot, you just say, well, wait a second, if you lend to any bank or financial firm that ever gets in trouble, why should they be cautious? Take any risk you want as a financial firm. You're going to get loans to get you out of trouble. And Bagehot said, well, that's a problem, but there are 2 types of firms. The truly insolvent, you don't want to bail them out, right? The bank manager who lent the $10 million on the swampland, they should go out of business. It's a market system. You made a lousy decision. He said the problem is that in a crisis, if you use mark-to-market accounting, meaning you say, right now, what is that loan worth? Right now, what is that bond worth? You're going to find a lot of firms that are insolvent, but only because there's a crisis. Yeah, it's a crisis, and so they can't get the rents they need on the commercial property to make the mortgage payments or whatever, or they're holding bonds whose value has fallen. These people are what I call, I made this phrase up, Bagehot solvent, meaning if it wasn't for the crisis, they would be solvent. And Bagehot said the key to ending a financial panic is you got to lend to them. The only reason they're in trouble is it's a crisis, and there's a liquidity problem. Okay, so to kind of wind this up to where are we now, Mr. Bagehot, meet Mr. Dodd and Mr. Frank. So after the financial crisis, Congress said we got to do something. Got to respond. And so a big piece of legislation was passed. It was the Dodd-Frank Act, right? Named after Christopher Dodd, senator from Connecticut, and Barney Frank, a congressman from Boston.
And during the financial crisis, basically Ben Bernanke and his colleagues, they lent to everybody, right? Remember, so we said that the Congress set up the Federal Reserve to lend to commercial banks. Bernanke lent to investment banks, lent to broker-dealers, he bought commercial paper. You know, I mean, you could have, in the crisis, you could have called up and said, you know, I've got, I got a used car here, you know, would the Fed lend me $1,000 on it? He probably would have done it. What was the legal authority to do that? Well, there's the Section 13.3 of the Federal Reserve Act, and it has this really broad language in it, or did, in unusual and exigent circumstances. So Bernanke and colleagues said, guess what? These are unusual and exigent circumstances, meaning it's a panic. They can discount, meaning loan, to any, it's really broad, right? Any individual, partnership or corporation. So basically, what they did is they said, Section 13.3 is hereby enacted. We're loaning to anybody we feel we need to loan to get us through the crisis. Okay, so Dodd and Frank changed that. The Dodd-Frank bill changed that. Congress didn't like that. You know? And they said, okay, we can't do that anymore. We're rewriting the language. Now it says, you know, that's something that said anybody, any individual, whatever, to discount for any participant in any program or facility with broad-based eligibility. What does that mean? Who is in a broad-based program with the Federal Reserve? Only commercial banks, right? Because that's what the legislation was originally about back in 1913, commercial banks. So essentially, only commercial banks. Now they threw in a little bone at the end that said, you may not establish any program or facility under this paragraph without prior approval of the Secretary of the Treasury. So that if you bring in the Secretary of the Treasury and you say, you know what, we can't just loan to commercial banks, we're going to have to loan to every investment bank that needs money, and he says okay, then you can do it. So there is that potential loophole, but there's a bunch of other stuff in there in that. Fed is no longer able to lend to any individual partnership or corporation. So remember, Bagehot said, lend to this man or that man, lend to anybody to get you through the panic, but only to participants in a program with broad-based eligibility. And specifically ruled out is a program or facility that is structured to remove assets from the balance sheet of a single and specific company or to establish for the purpose of assisting a single and specific company avoid bankruptcy, like Bear Stearns, like AIG, you know, companies where the Fed said, if this company fails, we're really in trouble. Can't do that anymore. If you're trying to pick out individual winners or losers, can't do it. In addition, Congress said, you know, we know there's a panic going on, but guess what? Within 7 days, you have to tell us everybody you're lending money to. It'd be a problem if, you know, you're a little reluctant as a firm to borrow from the Fed because then people know you're in trouble, and that by itself may cause you to be in bigger trouble. The justification for the loans, right? You know, Bernanke was like, you know, sleeping in his office at the Fed, but by the way, you know, send us an email telling us exactly why you're doing this. The value of the collateral, you know, in a panic, it's really hard to value collateral, right? Valuing the mortgage-backed securities, collateralized debt obligations, the credit default swaps, really hard to do because, you know, the market in them had evaporated. Nobody was buying or selling them, so what are their prices? And the projected costs of the taxpayers. In the end, none of those programs the Fed did cost the taxpayers anything. Taxpayers made a lot of money off them, but somehow you got to project that. The FDIC cannot expand guarantees to bank deposits. So in the crisis, the FDIC said, we're going from $100,000 a deposit to $250,000. You can't do that again. The Treasury cannot provide guarantees to money market funds without new legislative authority. In the crisis, money market funds ran into problems. Kind of running out of time here, so maybe I'll skip over that, but they ran into problems, and the Treasury bailed them out. Can't do that again. Okay, so why did they do these things? Well, politically, they make sense. People were mad at the Fed, mad at the Treasury, and you know, I don't want to denigrate the political ire here because some of it makes sense. You know, who elected Ben Bernanke? There was no election in which we got to vote yes or no on Ben Bernanke. Isn't it Congress that's supposed to, you know, decide where the money gets spent? So, you know, there were some political reasons why this made sense. But economically,
The problem we got is the financial system is likely to become more complex. It's hard to believe the financial system is going to become less complex. We're going to go back to the days with no ATMs. Will regulation be adequate to deal with that complexity? Maybe regulators are going to be really smart and they're going to say, oh, you can't do that, you can do this, you can't do that, you can do that, and we'll be fine. But if they're not that smart, or or the problem is just too complex, then we no longer can follow Bagehot's suggestion, which is to say, let the central bank get you out of financial panic by lending with a free hand, because we have reduced the flexibility of the Federal Reserve. So you can say economists failed to predict the 2008 financial crisis because they didn't realize the financial innovation had reduced the stability of the financial system. That's what happened. It's not our fault. Economists are unlikely to do any better in predicting the next financial crisis. We haven't gotten any smarter in the last 10 years. I certainly have not. My wife can tell you that. Dodd-Frank has left the federal government less capable of responding to a financial crisis than it was in 2008. Right? So I should say, we can certainly cross our fingers and hope we don't have another financial crisis. After all, we went from the 1930s to 2008 without a financial crisis. It may well be that within my lifetime, we don't have another one. The older I get, the more likely that becomes. In the lifetime of the students in the room, it's a little bit less likely. But if we have one, I think we've taken steps that seem to me to be counterproductive in the sense that we've made things more vulnerable. So let me stop there. I think I probably have just about exhausted the time, but if there's questions, I'm happy to take them. Thank you.
Okay, Rob, do we have a mic? John? Okay, if someone would like to ask a question, please raise your hand, and we'll send the mic over to you.
This is like my class.
There's one in the back.
Do you think the accumulation of student debt loans could potentially cause the next financial crisis?
Well, I think it's a problem. So the question was student debt loans, potentially another financial crisis. I think it's a problem, and maybe you're familiar with, there's a debate. The housing market has not bounced back nearly as well as many people expected. And some people have argued it's because many students have, and people who haven't been students for a number of years still have a lot of debt, and so are either unable to take on mortgage loans because they can't get a loan from the bank with the debt payments they have to make, or are unwilling because they feel they don't want to pay mortgage debt on top of that. I don't see that as necessarily leading to a crisis. I mean, it may be part of the reason why we have as slow a recovery as we've had.
I was just curious to see if you thought that any of the CEOs should have been blamed with criminal negligence or wrongdoing, or maybe that they simply close a blind eye to the fact that these credit default swaps would simply fail in the future?
Yeah, I would say that probably there wasn't, sort of criminal negligence. There have been various lawsuits about, civil liabilities, and, some fairly large judgments have come in against some of the financial firms. I mean, I think somebody like Lloyd Blankfein, who has survived and is still there and is still, making $30 million a year or whatever, I think I believe him when he says, I'm at the top of the firm and, I'm not selling the bonds and I'm not doing the risk analysis. And I think that like everybody else, they were kind of caught up in a situation where things had evolved in ways that they didn't quite grasp. Now, I should say, just in terms of the being more optimistic about the future, that risk management practices have just improved tremendously at all these firms. And commercial banks, they definitely have because of regulatory requirements, so that there were some very large commercial banks who had no risk management departments, and they all do now. And so in that respect, I think things have gotten better. But once again, I mean, things evolved in a way that people didn't quite understand before. It certainly could happen that way again.
I just wanted to ask, how do you think, I guess, the economy will react this time around when the Fed decides to raise interest rates?
It's a very interesting question. And, I think the Fed itself doesn't really know. And it's sort of hedging its bets, right? I mean, I think just about everybody thought that mid-2015, which we're almost at, was when the Fed would begin increasing short-term rates, raising their target for the federal funds rate, doing other things to try and nudge interest rates up. There has been some talk, if you listen to the speeches of the members of the Federal Open Market Committee, Bill Dudley, just a day or two ago, gave a speech in which he said, we may not, in fact, do it this year. And the couple of things they're pointing to are, one, the big increase in the value of the dollar, which has hurt U.S. exports. I mean, one of the reasons why we've gotten some mediocre real GDP numbers is exports have been held back because the value of the dollar has gone up, and U.S. products now cost more in other countries. The other is the decline in oil prices, which is a good thing from the point of view of consumers, right? Because we got more money to spend on stuff other than gasoline. But is definitely hurting investment spending, right? Because one of the rapidly increasing sectors was the oil exploration and oil development sector, and that has been significantly hit. So it may well be the case, it wouldn't shock me if we don't, in fact, see in 2015 interest rates go up. I think the economy should be able to get through that. Okay, I mean, we're really in uncharted waters. I'm sure that when the Fed brought the federal funds rate down effectively to zero in 2008, that nobody in the room that day would say that in April 2015, we would be sitting around discussing, should we get above zero? They would have thought we would have raised it years before. It turned out that the recession was a lot more severe than people thought, and the recovery has been slower than people thought. So, my guess is that when they do begin gradually nudging interest rates back up, the economy will be okay with it, but, it's an experiment that at some point we're going to have to run.
Can I ask one?
Sure.
What about the possibility that Greece will leave the Eurozone? Do you think that's likely, by the way? And if it does, what would be the implications for our economy?
That is a real unknown. I mean, there should be a deal to be made there that would allow Greece to receive the payments it needs without having to do things that clearly the current government, a left-wing government that was voted into office to try and put an end to the austerity. Effectively, the current terms are more austerity, and they're almost certainly not going to go along with that. There should be some compromise, I think, that would allow Greece to get the payments it needs, continue to service its debt, not have to default. If it were to default, I think it would be painful for Greece. I think that, would the euro survive? It's hard to say. Would there be dominoes with the other, countries that are on the, that have had problems not quite as severe as Greece's, but close? Would they then, would there be a run on them so that they would be forced out of the euro? And if the euro collapses, almost certainly that's very bad news for the U.S. because it's almost certainly going to mean a recession in Europe, and whether that would be enough to tip the U.S. into recession, it would almost certainly at least knock a significant amount off of U.S. growth. So
it's another wild card out there. I mean, I think there's a bargain to be made there that keeps Greece in the euro, keeps them repaying the debt, but it's really a question of politics, of whether the new Greek government and the debtors and the ECB can come together and figure out a deal.
Any other questions? Okay, please.
Okay, great. Thank you.
Join me in thanking Dr. O'Brien.
Thank you. It's my pleasure.